Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is September 29th, 2013 edition of Market Outlook. Please be sure to sign up for this video newsletter, and you'll get it every week. All right, well, certainly interesting developments on the political front, conversations between President of the United States and President of Iran, which is the first time, a bit of thawing of relations. Obviously, some pretty good potential peace dividends could emerge. And against that, we have the backdrop of the shenanigans on Capitol Hill. So let's see how the markets are playing out. Well, first of all, last week we noted the slingshot pattern, that key reversal pattern after the Fed announced it will not taper. We did indeed get a sell-off. We were actually down 4 out of the 5 days on a closing basis in most of the key indices. But we have a couple of interesting divergences. One thing I just wanted to point out is that we are trading within this channel. So I just want to show you this particular trend line here against the lows matches sort of this parallel line here, which we hit the top of. So we are bounding through this sort of channel line here, which is a channel within a channel in the bigger picture. But nonetheless, we did hit virtually the top of it. You can see we touched here, and if you look at the center trend line here, it also was a demarcation of a reversal of trend going back well over a year. So you can see how we hit this trend line several times, certainly starting in 2013, and every time we had traded back up to the top of that rising channel line, we sold off. But once we convincingly closed over it, it stayed intact. So why is that important? If indeed we do continue with the shenanigans on Capitol Hill and or developments on the political front in the Middle East deteriorate and reverse again, you certainly can get a sell-off. And our first logical test would be somewhere around where this channel or trend line comes in, which is about the 159 to 160 level, and also it coincides with the 200-day moving average. But meanwhile, you've got a pretty decent sized sell-off. Once we get to the market internals, you can see that there's still potentially some more to go, but that doesn't mean the market gets there. So the key point here is, right, a close under that 50-day moving average, which would also start to put pressure on filling the gap and potentially certainly testing this 161 to 162 level in the S&P. Now, one thing of concern, which we're going to get to, is the fact that the largest Dow stocks are definitely under a bit more pressure. So you can see here that the 50-day moving average, this blue line here, is pointing down, and we've closed under it. So we call this an unconfirmed warning, change to a warning from a bullish phase, and we're looking for confirmation of that if we get yet another close under the 50-day moving average. So overall, the market is definitely looking a bit shaky based on what's happening on Capitol Hill mostly. And of course, in the back of everyone's mind is, will the taper come into play in October? And again, we have to watch the economic news and the growth of the economy, because that's what the Fed is basing its decisions on. Let's take a look at some of the market internals as well. So if you look at the VIX, uncertainty in the market and that recent sell-off, you can see that we definitely have moved to a warning. This is definitely a bit of a negative overall. As you can see, the sentiment here in terms of the volatility index has now traded on Friday above both the 50 and the 200-day moving average. Now, it's not excessive. We're still trading basically in the middle of the Bollinger Bands, so that's sort of a neutral and sort of the middle of the trading range. However, this spike above the last couple weeks of action definitely tells you that there's a bit of nervousness in this market, and it can continue. So what we're doing is we're definitely going to watch what we do here around that 200-day moving average, which is right now around 1446. VIX closed at 1546. Pretty good size move. Now we've been actually trading the underlying, the VXX, which is the cash or the ETF based on a slightly different calculation of volatility. And you can see we sort of bounced off of that lower end of the Bollinger Band and basically closed up marginally on Friday. I mean, pretty good size move. I mean, actually, it's a 4% move, but still relative to where we are to all the moving averages, the actual tradable volatility index is looking not quite as fearful as the cash index that I just showed you. So a little bit of a disparity there. On the other hand, if you believe that the market is going to continue to be under pressure, this might be a bit underpriced at the moment relative to the looming fiscal issues that we have. So let's take a look at some of the other market internals. We had pointed out last week that we were concerned with that key reversal or slingshot pattern, and that we were looking for confirmation. We had already got the McClellan oscillator, which looks out over a couple week period to turn from a healthy bullish and potentially overbought to a sell signal, which we did get, and as you can see, we're working our way down. So we've got plenty of other room to the downside. Now, what we were looking for, we actually got. We were looking for the confirmation that the advanced decline would follow through and also generate a sell signal. So advanced decline on a shorter term 10-day basis along with up-down volume, all these are firing on the short side. So this is indicating potential more room on the downside until we get to those oversold readings and look for a bounce. So market internals weakening for sure, VIX showing nervousness. So overall composite reading for the market internals are clearly a negative. Okay, let's take a look at bonds. The TLTs, we had mentioned last week that there was a potential double bottom in play, and we were watching for a move over the 50-day, and clearly we did get it. Although you can see that the response through that 50-day moving average and this upper channel line and the bounce off of the longer term monthly charts and the longer term monthly moving average, which is very long term. This thing has not really been penetrated on the downside since 2011. This is really a critical level right here. So far, it looks like a double bottom is playing out. However, one thing you can say is that this move off of this trend line, off of the 50-day, and off of the 80 monthly has been relatively muted. So it's possible that as the market awaits more news from the Fed, you're going to get some more of this potential sideways action because we really did not accelerate through here. However, what you can say is a move back under the 50-day moving average and this channel line would obviously call this double bottom into question. On the other hand, a move above the 107.50 to 108 level in the TLTs would tell you that this potential head and shoulders bottom here that's sort of playing out could gather up some steam, which would be overall should be positive for the markets, but it could also be a knee-jerk reaction for people moving into bonds as the uncertainty on Capitol Hill plays out, and that could be actually a negative for stocks. So you got a real wild card here. Normally, lower rates would be good for stocks. In this scenario, it has not been playing out. In fact, with that situation on Capitol Hill, the reverse is actually occurring. Move up in the price of bonds, move down in the price of stocks, up in volatility. So things are sort of counter here based on the political events on Capitol Hill as well. So let's watch that critical 105.30 level in TLTs for a reversal of this change in phase and potential acceleration if we can get above the highs of last week, which is about 107, 107.10 or so. Let's see what that is. Yeah, maybe 107.30. So you definitely want to see a nice opening range type breakout on any move above the highs of last week as well. So that sort of wraps it up for now. Hope this was helpful. We basically are focusing on bonds, U.S. equities, and the market internals because that's where all the focus should be at the moment as the world awaits what happens here in the U.S. with Capitol Hill and the debt ceiling. Thanks. Bye for now, and see you next week.